Hi, my name is Joe Dowdle, and I'm a financial planner at Roth Asset Management. And we have reached the end of the year, so today I wanted to take just a few minutes to talk about some strategies you might want to implement to lower your 2024 tax bill. The first strategy I wanted to talk about is tax loss harvesting. Here's how it works. You can sell investments at a loss and then deduct that loss from your taxable income. Basically, that means if you're holding on to a losing investment, now might be a good time to sell that. Selling stocks at a loss helps you to offset capital gains and therefore lower this year's tax bill. One of my favorite ways for you to reduce your tax bill is to take advantage of a health savings account or an HSA. If you have a high deductible health insurance plan, contributing to an HSA allows you to benefit from triple tax savings. So what does that mean? Well, contributions are contributed pre-tax or tax deductible, earnings grow tax deferred, and withdrawals for qualified medical expenses are tax-free. Now, the 2024 limits for individuals is $4,150, and for families is $8,300. If you are over age 55, you have the option to do an extra $1,000 catch-up contribution. And since HSA balances roll over annually, you can continue to grow the account without worrying about spending it immediately. You might consider converting your IRA. If you had a lower income year in 2024, consider converting some or all of your traditional IRA to a Roth IRA. By converting, you would pay income taxes on the converted amount at your 2024 rates, potentially saving on taxes in the future. Once funds are in the Roth IRA, they are not subject to required minimum distributions, allowing them to grow without mandatory withdrawals into the future. Now, if you have not yet taken your required minimum distribution for 2024, make sure you do that by the end of the year. If you're over 73, you are required to take a minimum distribution from your retirement account, except for Roth IRAs. Your first RMD must be taken by April 1st of the year after you turn 73, and subsequent RMDs must be taken by December 31st of each year. Be mindful of the RMD rules to avoid potential penalties for missed distributions. Also, if you have an inherited IRA, make sure you're aware of whether or not you need to take a required distribution from that account as well. Another way that you could potentially reduce your tax bill is by optimizing your retirement accounts. Optimizing your retirement account is a way to lower your tax bill by contributing the topmost amount which is allowed by the IRS. Now, why is that? Because the amount you contribute is subtracted from your taxable income, it thereby reduces your tax bill. For example, in 2024, you can contribute up to $23,000 to your 401k to reduce your taxable income. If you're over age 50, your yearly 401k contribution limit goes up to $30,500. And for IRA accounts, the limit is either $7,000 or $8,000, depending on if you're over age 50. It is my goal as a financial planner to help my clients reduce their lifetime tax bill. And these are just some of the strategies that you may be able to implement to reduce your tax bill. Now, if any of these strategies are confusing or complicated, please reach out. I'm happy to help in any way I can. You can reach me at 469-423-1989 or shoot me an email at joe@worthassetmgmt.com. I'm always happy to help.